But if the West is looking for a bargain, Russia can give one the West can't refuse a gram for more. Russia countered the price peg of $60 with offering 2 barrels of oil at a peg for a gram of gold. Gold price doubles. Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics. And today we have a lot to cover in the silver and gold world. We're recording on Friday, December 9th, where we've seen another rally late in the day in the markets here. A lot of other things happening. We have central bank gold buying, a new Zoltan Poszar piece, and a lot of developments in the gold and silver space. So quite fortunate to be joined by my dear friend, Vince Lanci, partner at Echo Bay Partners and the founder of Goldfix Substack, one of top blogs out there for analysis of what's going on in silver and gold that I don't think you will find anywhere else. So Vince, great to have you back on the show as always. And how are you doing today, my friend?
I'm doing well. Thanks for having me. We have a couple good things to talk about. How have you been?
Doing well over here, and it's interesting to see the action in gold and silver towards the end of the year. Obviously, we've gotten towards perhaps the brunt of the rate hiking cycle being over. In a couple of days, we'll see what the Fed has planned. Looks like they're heading towards 50 basis points. Yet, going to pull up the chart again. We're recording on Friday, December 9th, and see silver having another big day, up almost 60 cents, approaching $24, which would have sounded quite far-fetched just even a couple of weeks ago. Here, if we take a look back over the past 6 months, back down there in mid-October, around $18. So quite a significant rally. We're seeing the same in gold today, up over $1,800. So Vince, you've been talking about a lot of these things in your Goldfix Substack. Obviously, you've highlighted a lot of the mainstream investment banks even giving gold recommendations going into 2023. So why don't we start there, and love to get your thoughts on what you see happening in the metals right now.
Well, I think you can cover all the mainstream banks by just putting it under an umbrella of it's asset allocation time, asset reallocation time, or what I call buy season for the metals. And we've talked about this before, but just briefly, as you know, it's the time of year where mechanical allocations, at least in futures, start to overwhelm fundamental factors or even monetary factors. And what that means, quite simply is as we approach the end of the year, investors are thinking about what they want to do for 2023. Investment banks, investment advisors, they have to come up with a plan. And those plans are for reallocation. Maybe it's for more income, less income, tax, inflation would be a big theme this year. So the banks and the investment advisors start putting out their allocations, their suggestions or recommendations. And typically within the commodities world, and I'm talking about silver and gold versus oil, right? So silver is separate than gold, but silver and gold versus oil. They look at commodities as inflation hedges. Whether it's good or not is another conversation as an inflation hedge. But that's the sales point. And traditionally what will happen is the high net worth individuals as well as smaller hedge funds will be given these suggestions. We think 10% of your money should be in commodities. And of that money in commodities, half of it should be in gold, half of it should be in oil. And that's like your simple version. But what happens is after you've had a big year, and I think we're seeing this right now, after you've had a big year in silver's a different story, but after you had a big year in oil, even though it's cratering right now, you've had people that have been long oil at the investment level for a couple of years now. And what banks do is they say, okay, we want to keep your money in commodities, but in a dollar cost averaging sort of way, gold is cheap relative to oil. So let's sell some oil and buy some gold. And so you'll see the allocations change from, we're going to put 80% of our commodity money into oil and 20% of gold, to 50 and 50. So now you have money flowing out of oil into gold and silver as well. I'll get to that in a second. And that's what you're seeing now. One of the reasons that oil is selling off, one of several, but one of the reasons that there's a tailwind behind oil sell-off and the precious metals rally is the reallocation season. So that's what the banks are doing. That serves as an underpinning for this time of year. And this time of year starts right around Thanksgiving and ends January 6th. The reason I picked January 6th is because January 6th is when the new allocations officially come out. So it's a buy the rumor, sell the news sort of thing. I'm speaking, it's my dog having a fit there. Okay, still alive. The buy the rumor, sell the concept is basically, the allocations come out on January 6th, but everyone knows about them before then. Everyone's hinted about them. And so, like any leaky boat, the trade is to be long speculatively from Thanksgiving and out by January. So we'll see how that happens. But there's obviously a lot more going on, especially in precious metals, that creates the allocation necessity to put more money into metals. And then specifically in silver, you have relentless physical buying. You have some assets that are starting to perform on the miner side. And by the way, we should talk about miners. Those are leading this time, and that's very good. And you have, technically, I think silver it's in a buy range now. So there's a lot of good reasons. The most important reason, the driving reason for the next 2 to 10 years behind precious metal strength will be this potential risk of inflation, but not inflation like we're used to. Inflation that's an economic of the economic reset flavor. Inflation that's a retooling of a whole economy. Inflation that's a byproduct of going green, or inflation that's a product of not going green, but you're going to have it because the economies globally are changing. But that's huge picture. Anyway, the metals are buy until January 6th, speculatively speaking.
Yeah, well, that will certainly be interesting as we go into 2023, seeing how those reallocations play out. Another piece that I know people on Wall Street and certainly in the financial community are looking at is a piece that Zoltan Poszar put out talking about oil and gold. Got some interesting comments in this one, especially with everything that is going on with Russia and their energy, where now there has been that $60 price cap placed on Russian oil. And I will read this excerpt here. Cap of $60 per barrel for Russian oil equals the price of a gram of gold at current market prices. Let's imagine this setup as a peg. G7 led by the U.S. effectively pegs the U.S. dollar to euros at $60 per barrel. In turn, Russia pegs euros to gold at the same price, gram of gold for a barrel of oils. U.S. dollar effectively gets revalued versus Russian oil, a barrel for less. The Western side is looking for a bargain, effectively forcing a price on the plus in OPEC plus. But if the West is looking for a bargain, Russia can give one. The West can't refuse a gram for more. Russia countered the price peg of $60 with offering 2 barrels of oil at a peg for a gram of gold. Gold price doubles. Russia won't produce more oil, but would ensure that there's enough demand that production doesn't get shut. And it would also ensure that more oil goes to Europe than to the U.S. through India. And most important, gold from 1,800 to close to 3,600 would increase the value of Russia's gold reserves and its gold output at home and in a range of countries in Africa. Crazy, yes. Improbable, no. This was a year of unthinkable macro scenarios and the return of statecraft as the dominant force driving monetary and fiscal decisions. So again, obviously, we did finally get that price cap on the $60 oil barrel. So do you think that cap is going to be effective? And thoughts on what Zoltan writes here?
Well, the cap will not be effective, and it will not be effective by design. There are multiple ways around the cap, and to be fair, we've been talking about this off and on for almost 6 months. So everybody's had plenty of time to position themselves to circumvent or work around any cap that's implemented. That's first of all. The other reason is tactically or logistically, you can get around it by changing tanker sizes. It's good old fashioned, smoke and mirror stuff. And I think just from some work that I've read, I think the reason that to paraphrase Goldman Sachs, the reason that the reason that the cap has no teeth, and by that I mean it's hard to enforce. I think Yellen actually made a comment that we basically would look the other way if people cheat in India by buying. Was they wanted to minimize the risk of Russia retaliating, and so you have a price cap, you save face at home. It becomes political versus geopolitical. And the price cap, to the extent that it does not have teeth, then everybody does what they want, and everybody's like a wink and a nod type of thing. So the price cap is ceremonial at this point. Can it become? But it can become a bigger problem if oil were to rally. I don't know if that'll happen, but generally speaking, the cap in its current form is hardly easy to enforce and doesn't really have teeth. There's ways around it, which we could take up a whole other conversation having, and we might off there, right? The Zoltan piece, the paragraph that you showed, the section that you showed, that is the most circulated paragraph, section right now going around in the precious metals community, and for all the right reasons, 1800, 3600. And I don't want you to come off that page. I don't want to talk about the other stuff yet, but that is his worst case scenario. And I read that, and I read comments by people that are, anti-gold and pro-gold, or let's just say Keynesian and Austrian, or, dollar and anyway. And the ones that we know what the ones that are pro-gold and pro-silver said, but the ones that were anti were like, well, that'll never happen because of X, because of Y, because of Z. And I think they're missing a major point here. He's not saying it's going to happen. He's saying if it happened, this is what could happen. Now, this is his worst case scenario. This is an example of a worst case scenario. And what he's saying is to put it in human terms, right? To put it in, guys on the street terms. Hey, the U.S. government says it can't let me sell oil for $61 a barrel. So I'm going to sell for $60 a barrel. And plus maybe I'll sell for $50 a barrel plus a tenth of a gram of gold. Maybe I'll sell it for the equivalent in gold. Well, how much did you sell the oil for? I didn't sell it for dollars. I sold it for gold. I sold it for a gram of gold. You're pricing oil in gold. You're not pricing oil in dollars, which is the whole concept behind the reserve currency. And the key is the word currency. And he talks about this later on, he touches on it. I'm actually writing about this now. It's one thing to have gold be a store of value. Why do I put my money in gold if I'm a central bank? Because it's a store of value, because it won't deteriorate, because I have no risk, because there's no counterparty risk, because I can go back to it and not worry about it disappearing. But a medium of exchange is a different function, and it's an important function. And when in the dyad of gold silver over back in Roman times, it was gold is where you store your value, and silver is your currency, and you store value in both, but silver was easier to work with. There was more of it around, but it was still precious. So when you look at the Zoltan concept, what he's really saying is, my dog here. What he's saying is, if you're all about dollars, then we won't trade it in dollars. We'll barter it. Now, bartering is not the right word, but I want to use it to simplify it, right? We'll barter for it. I'll give you a barrel of oil for 1,000 sheep. Well, what's 1,000 sheep worth? I don't care. I'm not pricing the dollars. I'm pricing it in sheep. right? So as a commodity, I don't care about your dollars. I care about gold. So in his scenario, it's, you know what? If the price of gold is if the price of gold is $1,800 an ounce, and the price of oil is about $60, and the Urals oil is about $60, and the price of gold comes out to be about a gram for $60, well, why don't we just say the price of oil is still $60, or 2 grams of gold? Now, I think most people in the West would be, that's ridiculous. That's ridiculous. I mean, to really look at it at the base roots, because this ties in with Ghana, right? At the base level, we would spend $60. We wouldn't spend 2 ounces of gold for a barrel of oil. Why? Well, for many reasons. One reason is there's a lot more dollars than there is gold, right? And we have dollars. Theoretically, not theoretically, practically, we're not, you and I mean, we're long precious metals, right? But we're short precious metals compared to dollars. We have more dollars, maybe, I don't know about you, maybe more dollars than precious metals. If you say a percentage of my net worth is in precious metals, well, then, and it's not more than 100%, well, then you're long dollars, we all are. Now go to Ghana, a country that can't get dollars, a country that has no dollars, but a country that needs fuel, a country that needs to, I don't know if it gets cold there, right? It's at the equator, right? A country that needs energy for their economy. They got plenty of gold. Well, shit, 2 ounces of gold, fine. I'll pay 2 ounces of gold. Well, why? Well, that's twice the amount in dollars. Yeah, I know, but I need my dollars to buy Levi's, to buy whatever else that transacts in dollars. But oil is in gold. You know what? I'll pay the 2 grams of gold. And what'll happen is, economically, you and I are spending $60 for oil, and is it Guyanese? Well, the people in Ghana no, that's Guyana. The people in Ghana are spending 2 grams of gold. Okay, well, what's going to happen is the price of oil is going to go up in dollars. Not all at once, like Zoltan is saying. The price of oil goes up in dollars. The price of gold goes down in dollars. Okay, in the beginning, right? So it's like oil's $60, right? So now you got a guy who's selling you oil, right? Let's say it's a Russian guy, right? And he says, I'll take $60 for oil or 2 grams of gold. And we say, well, here's $60. He goes, yeah, $60 isn't enough, but I can't take $120 in dollars. I'll take $60 in dollars and throw in a gram of gold. So what happens is, eventually, whoever the strong hand is in the conversation starts to demand more money. We can't get our oil anymore. Let's pretend there's no other oil in the world. We can't, $60. What do you mean he wants 2 ounces of gold? So what do we do? So meanwhile, you got the people in Ghana going, 2 ounces of gold, and you're digging all the gold up, and you're saying, we need the fuel. And so the price of gold is going down because more of it's coming on the market, right? That's fine. But eventually the US goes, well, we can't buy our oil for $60 anymore, $61. So we go to Ghana, we'll buy your gold all the way up to $120. So you create a global arbitrage, a secular global arbitrage. You make gold the currency. And in that worst case scenario, the price of oil is 2 grams of gold. The price of gold is 1 barrel of oil. The price of gold is $120. And it's all because of oil. And, the oil gold relationship, which people who know fundamentals, people who know economics fundamentals, know that oil is economic energy. Well, other energy is economic energy. Energy is what makes an economy go. And gold is a store of energy. How much? Well, I mean, it's an emotional asset, but it's a store of energy. What's it worth? Well, it's worth how much you have to pull it out of the ground. It's worth, why is it a store? It is what it is because it's perfect. Incidentally, to kiss up a little bit, silver, I've said this before, silver is better than perfect, but we'll talk about that later on. But what ends up happening is if this were to happen in Zoltan's, scenario, good money, now you've got Gresham's law. Good money drives out bad. So there's more dollars in the world than there is gold. And eventually, it even could happen overnight. If eventually anybody who has oil that's selling it for less than 2 grams of gold will be bought for $60 and resold to Ghana for 2 grams of gold. And that gold will be, gold's money. And so Russia could feasibly do that, because all they need to do is, if there are only 2 things that Russia needs to exist, and I'm not saying they're the strong hand here, but the hypothetical goes like this. Russia has oil. Russia needs pistachio nuts, right? That's all they eat is pistachio nuts, right? So Russia wants to sell oil for, actually pistachio nuts is actually good only if they're doing it with Turkey. Russia has oil, but Russia needs to buy things, and China has gold. So Russia will take gold. This is what's going on. Russia will take gold from another country for oil, because if it ever needs dollars again, which they just proved that they do from time to time, they just go to China and say, here's some gold, give us some dollars, give us some fiat. So it's become like the dollar becomes your emergency fund, and when you need it, right? And gold becomes your transactional medium. Anyway, I'm probably butchering that, but the bottom line is, in Zoltan's worst case scenario, gold doubles overnight because they start to price assets in gold, not in dollars. People are reacting to that. The thing that he describes above that, very loosely, because he's talking about a lot of things, and I'm going to write about the whole report, but right now I'm writing a piece on the gold section specifically. But what he talks about above that, which is a little bit convoluted for mere mortals like ourselves, is a lot more possible, and that is he's basically saying what Ghana did. Now, assuming that they actually are being honest about it, Ghana is saying, we're going to buy oil or fuel oil, right? Energy with gold. And the person this is what they're saying, they're representing this. The seller of the fuel oil to us says we don't have to convert the gold to dollars. They'll take it as gold. So what does that do? Well, that says 2 really important things. One is obvious, one is not so obvious. The obvious one, I think, for all of us is well, if they're not selling if they're not selling the gold to get first of all, on a micro thing, they're not losing money because they're not doing an unnecessary transaction. There's no friction. There's no intermediary. Okay, fine. That's simple, right? Well, assuming that the price is right, they're getting the actual price of spot gold. You free up the dollars on Ghana's balance sheet to not be used. You make their currency, the SETI or however it's called, less vulnerable to having to be sold to raise dollars to go buy those fuel oil. So now you can use it to buy color TVs, which we were talking about before, or Levi's jeans, right? Maybe you don't want a color TV, but the point is there's no pressure to carry as many dollars on your balance sheet. You've demoted the dollar as a reserve currency. That's the one that I think we all can wrap our heads around. It's like, wow, it's the barter concept, right? But it's not barter because barter says, I get fuel oil, they get gold, and they trade the gold for something else. Like that's bartering, like they convert, but it's not. See, the key to this is I think this is the speculative part. Ghana doesn't say that unless they've been given permission. You don't talk about that. You don't challenge the dollar passively or actively on a world stage. The number 2 African gold producer, I think. I don't care how big you are for gold. You don't do that unless you've got a contract signed, sealed, and delivered by someone who has told you, we will take the gold. So let's assume it's Russia. Could be anyone, but let's assume it's Russia. Russia says, okay, we'll take the gold. You don't have to use dollars. we want your gold. We can always get rid of our gold to China if we have to. But they're not going to get rid of the gold because, I mean, look, Ghana is saying, I'm selling oil for gold. I'm buying oil for gold. Russia, in this hypothetical, is saying, I'm not buying gold. I'm being paid in gold. And who will take gold on the other side? Russia needs to buy whatever China makes, sneakers, right? China makes sneakers, let's say, and everybody in Russia needs to get sneakers. China's going to get paid in gold for sneakers. That's not bartering. That's money. That's currency, right? So it could all be a hoax or a ruse. Russia's just going to basically use them as a scapegoat or a sacrificial lamb, and that may happen. But the sheer nerve to even say that itself makes you and me say, well, I need $5 more to sell my gold. And all of a sudden, gold becomes money. And that's extremely dangerous. It's extremely dangerous for the world. And, it won't happen the way Zoltan is talking about, God forbid, for the world, not for my portfolio. But what he's saying is, it's an extension of what he said in February. And what he said in February, very simply, was we have a crisis. I think that we have a crisis of coming of commodities, a crisis of collateral, right? So the East makes oil, the East makes rubber and the West makes tires, right? And so we just take their rubber and we lever. We make $1 trillion in rubber and make $20 trillion in tires. So the inflation goes into the finished product. And we say, well, the rubber is really not that important. It's our technology and our entrepreneurship. And then it gets so bad that these third world countries that are being basically monetarily colonized say, you know what? We're not selling our rubber to you anymore. We're going to sell it to Russia. The supply chain, whole COVID thing that happened. And now it's like you have a shortage of collateral. So you can't do this $20 trillion in tire deals because you don't have the rubber coming in. Well, that's what happened with nickel, with lead, with steel. It's like your leverage, your financial leverage gets destroyed because the bottom of your pyramid, right? As you move further down the pyramid, the support, even though it's like a pyramid inverted in terms of size, it should be like this in terms of importance. It's the roots of a tree, The tire is the leaf and the flower. The rubber that makes the tire is the root. It's the raw material. It's the, I'm trying to sound like a hippie here, but it's real. And so this collateral shortage that Zoltan was warning about, it happened. Months later, boom, it happened. And now he's saying, well, there's a shortage of gold collateral. And there's a shortage of gold collateral for the Western banks to cover their positions in terms of deliverable risk. Well, then you've got a recipe for the same thing happening in gold and silver. By the way, silver will be, as you link, by the way, just as an aside, so I want to get this out there. As you tie gold to oil, you tie natural resource to resource. As you tie gold to oil, and you tie silver to gold. It's that simple. And now the lunatics over the years have been saying, well, what's the ratio of gold to silver in the ground? What is it, Chris?
About 9 or 10 to 1.
Yeah, 10 to 1, right? Exactly. And so we're like 71 is ridiculous. It should be 10 to 1. And I'd be like, and I'm a person who owns it. I was like, you guys are crazy. You guys are just nuts. Well, guess what? That's not nuts. If oil is worth 2 grams of gold, and those are not just the fact that silver goes up because it's 2 grams of gold because of inflation. It's because you reestablish the earth link. You reestablish the natural resource link, gold, oil, silver. And you're going to get it closer to I don't want to hype that, but if gold were remonetized tomorrow, the silver gold ratio would probably go to something like, under 30 to 1. Sure, it would. That's it. you know. Um, so that's the Zoltan. That's the gold piece of Zoltan. Which, by the way, I'm writing it out now for the Substack. How what Zoltan talks about manifests, and it manifests with backwardation. It manifests with exchanges shutting down. It manifests with J.P. Morgan defaulting on their silver future shorts and saying, I've got the metal. I don't care. It's a contract. I've got the metal. Anyway, so I could go on and on as I already have. But that's it.
Well, thank you to Vince for everything he shared there. Certainly interesting times with what is going on with these gold and silver markets, especially as we are now seeing gold pop up as money in more and more occurrences. And obviously, with de-dollarization and tensions continuing around the globe, seems like we're continued headed down that path, which is why we talk about gold and silver so much. So hopefully you enjoyed that. Again, you can find Vince's great writing at goldfix.substack.com. And before we wrap up today, would like to thank Kuya Silver, who brought us today's video. Kuya, which is building the next high margin silver mining company down in Peru. They have their flagship Bethania asset, although they've also been continuing their exploration at Carmelitas, where recently they finished a sampling program that came back with 1,944 grams per ton silver equivalent, reading of 1,315 grams per ton silver. 9 new veins identified at the Carmelitas zone, another 6 veins identified 1.2 kilometers north of the Carmelitas zone. So good to see that their exploration is going well. Of course, as I mentioned, in addition to their Bethania flagship asset, which will be going into production in 2023, small capex and a short repayment period, with their plan to go into production, increase the amount of metal they are producing as they continue their exploration. Kuya also on Friday did announce that they are doing a $2 million Canadian private placement financing with shares priced at 50 cents Canadian, and also offering a 1/2 of 1 share warrant, which is priced at 70 cents Canadian for a period of 36 months from the date of issuance. That will be used for their exploration program. And you can find out more about that at kuyasilver.com. So if you would like to participate or just find out more information, go to kuyasilver.com. And thanks again to Kuya for bringing us today's show. And I will see you again tomorrow with part 2 with Vince Lanci.